Hi, and good afternoon. My name is Ruth McCambridge, and I'm the editor-in-chief of the Nonprofit Quarterly. Today, we are proud to welcome you to an update on FASB requirements, disclosures, endowments, and cash flows. Oh my! I want to introduce our two presenters today from FMA, Hilda Polanco and Gina McDonald, and they will be taking charge of the presentation. After it's done, I will rejoin you and help facilitate a conversation about what we've learned. 2018 is on us already, and the Financial Standards Accounting Board's changes to nonprofit reporting are now applicable for calendar year, the reporting year, which is the same as the calendar year 2018. Oh, that's two different reporting years, right? Okay, so they'll explain that to you. We've been talking about the new requirements for several months and the important changes your nonprofit will need to make in order to remain compliant to them. This is a complicated and critical issue, so we've been tackling it one piece at a time. Today in part 3, we'll rediscuss FASB's new liquidity disclosure for nonprofits and financial statement presentation, as well as go on a deeper dive into some lesser discussed aspects of FASB's changes to nonprofit reporting, including such stuff as expense allocation, investment expenses, and underwater endowments. Today's free webinar, it is free to you today because it's brought to you by AccuFund. AccuFund is the accounting software nonprofits have relied on since 2001. AccuFund provides fund accounting solutions which satisfy the new FASB requirements and brings them to nonprofits who understand that transparency and accountability begin with sound financials. Before we really get started, I do want to let everybody know that this session will be recorded, and you will be sent a copy of the recording and the slides once the recording is complete, probably in the next day or so. So you don't need to ask us if we're going to do that. We will do that. And then they will also be made freely available on our website. So that you'll be able to search for this and the two previous ones that we've done, and we will do one subsequent one in the next month or so. Don't forget to join us for the fourth and final part of the series on May 22nd, in which we'll discuss readiness assessments and implementation. You can follow our discussion on social media today using our special hashtag FASBReady. So I am again very pleased to be joined today by Fiscal Management Associates founder and CEO Hilda Polanco. Hi, Hilda.
Hi, Ruth.
Good to have you back. And lead consultant Gina McDonald. Gina and Hilda are frequent presenters at NPQ webinars and very popular presenters. And they always have very valuable insight to share. So we're excited to be able to learn from them today. For those of you, we're going to try to stop about 15 minutes before the hour to allow you time to ask questions. So if any of you have questions that occur to you in the course of the webinar, go ahead and log them in whenever they come to you in the box marked questions on the right-hand side of the screen. I may choose between them depending on what's already been answered in the presentation, but it will give me a sense of where the interest lies on particular pieces of the issues that are brought up during the seminar. With that, I want to hand this over to Hilda and Gina, and they're going to walk us through a kind of an updated understanding of what these requirements will mean for you, and then we're going to take questions. Thank you. Hilda?
Thank you, Ruth. It's a pleasure for Gina and I to join you today. And we will be moving forward. So if we could just move on to the next slide, that's us, and we can move on beyond that to the next slide. So just to remind everyone, we've been working on this now for about a year, getting you the information that we want you to have. And these standard updates are referred to as the ASU and ASU 2016-14. They were issued in 2016. It's the first major revision since 1993. And as Ruth mentioned earlier, they're already effective for 2018 or fiscal year 2019. So many of you that have a June 30th year end, for example, July 1, 2018 is the beginning of the year. Some of you may already have thought about this as it relates to your budgeting process, not only year-end financials, but how it sort of comes across your entire system. So we'll mention specific areas where you may want to be thinking about this throughout the year. Think of 2018 as a dress rehearsal for what it will look like in ultimate presentation, so that when the auditors come in, you will actually be ready. Next slide. The actual focus is really on understanding the financial information and helping readers of those financials make better decisions. It's not necessarily drastically different. It's just a few changes, and it's for stakeholders of all sorts. So the board of directors will need to understand what these new requirements are. The new donors, the funders and donors of nonprofits have been wondering, what does this mean and how will it look different? And bankers for sure are looking to these new standards to become more familiar with them and to see what information is more available. Next slide. In terms of the changes, we want to remind you that they're not changes in accounting principles. They're more changes on presentation and disclosures. And we want to remind you that the disclosures are yours. And interestingly enough, as you'll hear from us throughout our conversation today, even the financial statement presentation still has some interpretation. That's up to you in terms of how you'd like to represent things. So we hope that these webinars help you think through, what's the most strategic way for me to present my information? What's my message that I want my stakeholders to be aware of? And we'll give you some examples today of how the FASB is giving us flexibility in terms of how we present it. In terms of the key provisions, our next slide shows us what was included originally in all of these changes. So liquidity and availability we see as the cornerstone of the changes from the ASU, and we spent some time in part 1 of the series describing what that is. We also then in part 2 covered the net asset classification and the expenses. The net asset classification relating to how we disclose our donor restricted funds, and expenses, the statement of functional expenses, which will remind us all today what that means in terms of your budgeting and other systems. The statement of cash flows and investment returns are the two remaining topics. Statement of cash flows is very much a formatting guidance, and we won't be spending any time on it today. We feel that you can quickly catch up on that with your audit firm. Return on investments is a topic that we'll be covering today, and how we present those. In terms of what we are framing for today, there will be some recaps of what the concepts were. We realize even if you joined us, it was some time ago, and some field updates. We've been keeping track of the changes. Anytime new accounting rules are issued, there's a lot that's learned just from people coming out and doing it for the first time. So we're bringing you today lessons from the field that we want to share with you for you to be aware of how things are rolling out and what questions are coming up. We will continue tracking this through the summer when the AICPA conference happens in June, and we encourage you to be aware of the changes as they continue beyond our time together. I'm going to pass this over now to Gina, who's going to give us some recap and some updates in terms of these areas. And then I'll be joining Gina in each of the areas, sharing what I've seen with clients and what we've seen in the field in the interpretation of these updates. So Gina, take it away.
Great, thank you. So if we could turn to the next slide. I'm going to review, as Hilda mentioned, 3 areas that we touched upon in our prior webinars, giving some breaking news or some updates, some things that we've learned now in coming out from the field as FASB offers us new information and as different nonprofits try and interpret what's in these new FASB rules. So as Hilda mentioned, we see this new disclosure surrounding liquidity and really ability to pay bills and cash flow really as a cornerstone of this new guidance. We're looking at new disclosures which are forward focused, whereas most of the information in our financial statements is historical information. This one is going to require us to include a quantitative calculation that's going to tell the reader of our financial statements what we have available in terms of financial assets at the balance sheet date, really to meet our general expenditures for 1 year in the future. So there's going to be a table with numbers, and then there's also going to be a qualitative disclosure in words. So we're all looking for more guidance as to what does this mean? What will it look like? What on earth are general expenditures and how is that defined? What we've learned is sort of on purpose, by design, FASB is not defining this term, general expenditures. So this continues to be one area where there's going to be interpretation for each nonprofit to determine, gosh, you know, what in my budget do we consider to be our general expenditures? That's going to be a key area when we look to this disclosure that we'll have to define for ourselves on an individual basis. If we can go to the next slide, also what we're learning is that this concept of availability is something that can vary depending on our revenue streams. So FASB is looking to measure available financial resources, right? What we have available to pay our bills in 1 year. Our availability can vary if we have restricted dollars that may not be earmarked, say, or available for general purposes, but earmarked for something special. That can affect availability and that calculation that we have to disclose. If we have dollars that we have received for the future, that can affect that 1 year availability measure as well. We also learned something really interesting in that it's possible for this concept of available financial resources to result in a negative number. We might have negative availability. And so this was a question that has come through very often as to, you know, could the number ever be negative, and, you know, how could it be negative? So if we move to the next slide, let's sort of take a look at how it could be negative.
And so in this example, and we jump to how it could be negative because we want to bring attention to this. Think of this as long-term planning for you. If you have been experiencing liquidity challenges, if you're wondering, are my resources too restricted by donors? Or in the previous slide, Gina mentioned these are limitations of availability, not just by donors, but also internally as well. So if you have a board designated reserve where your board is very specific about what its purpose is, those funds may not meet the criteria of availability for purposes of this disclosure. If you have long-term commitments from donors, which we always celebrate and hope for, where we have multi-year commitments, some of those commitments may be beyond a year. And so when we look at our balance sheet and we say, well, what are financial assets? And in our first webinar, we went into what that definition is. Typically, they are financial assets. Those are the assets that are liquid and available to pay commitments. Cash and cash equivalents would obviously be the first. When we look at our total financial assets, we may have receivables. And I want to remind everyone that it could be current, meaning the provider, the funder is going to pay within a year, or it could be long-term receivables also that are in this financial asset. So in our example here, this organization has available financial assets of about $65,000. That's cash and cash equivalents, and they have current and long-term receivables. The first question we need to ask ourselves is, are any of those receivables of $40,000 to be collected in more than 1 year? So think of availability as resources available to us, liquidity to us within 1 year. In this theoretical example, of the $40,000 in receivables, $25,000 is actually for a year into the future. So those would not be available and liquid for us in the coming year to meet our general expenses that Gina discussed. We also could have donor contributed dollars that are for future periods in excess of a year. And you might say, well, how's that possible that I would have $55,000 if I only have $25,000 in the bank? Well, maybe these are those multi-year grants that actually issue the cash up front. We deposit it in our bank account, and then we go and we run our organization. In this hypothetical situation, obviously to make the point that if we have resources in the bank and in our receivables that are earmarked for a year from the future, you could have negative availability because we have resources that are available to us or have been utilized in other regards, and we now have this negative availability for the future. So why do we bring this up? We bring up the worst possible case, which would be when the availability is negative, so that you can start to think about what would my disclosure look like. If I did the disclosure at the end of 2017, just to see where we ended the year, what would this look like? And what would it look like if I did it middle of the year? The end result is we have two places to look. If you have long-term restricted dollars, they're not available. So we always want to know what are those dollars that we've already taken in. And if we have long-term receivables, or if you have these, my example here are external. If we have board designated reserves that tie up our resources in long-term investments and they're not available for daily cash flow, then that's going to be a limitation. We encourage you, if you have reserves, to review your policy in the context of availability. If the reserve policy says that your available reserves are available for spending if needed, then that would affect the disclosure. So the takeaway here is make sure that you understand your reserve policy if you have a board reserve, and that you understand from a restricted perspective cash and receivables that are for activities more than a year from now, that year being critical. Gina, I'm going to turn it back to you for another update.
Great. We could go to the next slide. So again here, we're looking at financial statement presentation. So we know in terms of all the various changes that are encompassed in this new FASB guidance, the one that seems to have a lot of conversation going around is this concept that unrestricted net assets will be titled something different going forward in our external reporting. So we know and we discussed that unrestricted net assets is now going to be titled net assets without donor restrictions. We also know that in our external reporting, temporarily restricted net assets and permanently restricted net assets will be combined in a new category titled net assets with donor restrictions. And so if we move to the next slide, what we have is some information from the field again, some updates in terms of, how is this being interpreted? What does this mean? And so if we recall, the whole point to these changes is to give more information, provide more transparency for individuals looking at our financial statements and trying to make judgments. We mentioned our various stakeholders, users of the financial, the board, donors, general public, our, other various funders. So the initial feedback from this wording change from a lot of nonprofits was that, gosh, this seems to provide less information because I'm combining two categories. So the message here in the update here from the FASB is that they want to remind us that there is flexibility in the presentation and that their intention is not to provide less information. They want to remind everyone more information is okay, but that we've got some labeling changes. And so it's okay to provide additional breakout, for instance, of these individual categories. So in the without donor restriction category, we know it's made up of potentially several items, which include undesignated, which would be truly free and clear from all restrictions. Hilda mentioned we could have internal restrictions. So in our category without donor restrictions, which remember that used to be our unrestricted, we have our board designated reserves, which could be, things like our operating reserves or board designated for other purposes. In the other category, again, which used to be our restricted categories, temp and perm, we have this overarching donor restricted category, which is everything else, anything with an external restriction. But we know we've got endowments in that category. We might have program or purpose restricted, and we could have time restricted. It could vary. What we want to show you today are some options for flexibility in presentation where we would be using the new headings and the new titles, but not limiting the amount of information we're showing in order to give clarity on the composition of those categories. So if we move to the next slide, Hilda, it'd be great if you sort of walk through some options we have here for presentation.
Thank you, absolutely. So we're starting with the statement of financial position, which, as you know, is where you are at the end of a fiscal period. And we're envisioning what it might look like at June 30th, 2019. And today, they would say restricted or unrestricted, and restricted is in two forms, temporarily or permanently. And I think if we look at this new labeling, the FASB's goal was, let's say it in English, with restrictions, without restrictions. Those are the two labels. But as Gina said, that means there could be many different things within those categories. And the disclosure, and normally we think of disclosure as footnotes. I think I want you to broaden that understanding to think of disclosure as presentation style. It could be the way you choose to present your financial position. It's the way you choose to present your statement of activities. That's disclosure decisions. And then there are footnotes as well. Looking at the balance sheet or the statement of financial position, we have some ideas over to the right. So without donor restriction, there may be undesignated, totally and available, clear, and we may have board designated operating reserves. So now the reader can see that even though it looks like I have 75,000 in no designated restriction funds, there actually is a restriction on 50,000 of that. And if I turn to the footnotes, I would learn more about how restricted that reserve is and where it might be invested. Remember, this connects to the liquidity disclosure and available for paying bills. So we've got undesignated, we've got the board designated. Then we have with donor restrictions. And I think here's where, again, we're using more layman's terms. So instead of permanently restricted, we're using the word endowment. Folks understand what that is. Program restricted or time restricted for future periods. That should be a signal that to the degree that that 12,000 is in cash or receivables, that's for future periods, and I won't be able to use all of it beyond the 1 year availability. So it could be on the face of the net assets schedule or the component of the balance sheet, or it could be in a footnote. But we encourage you to disclose those elements that are going to clarify your financial story. If we look at the next slide, this is an alternative for the statement of activities. And this is exciting to think of. How can I tell my story about my donor restrictions and my internal restrictions? I have always favored the columnar approach to see the levels of restrictions across the organization. So my first example, I'm focusing on the donor restriction concept. So in this example, without donor restrictions, we're showing just as one column as we normally do today, the unrestricted column. And then we're showing the with donor restriction presentation. For my example here, there are two types of restrictions, the endowment and program restrictions. In my example here, those are the two. So notice that the statement doesn't look very different from today's presentation. Expenses are still in the unrestricted column. So we're not changing the concept that expenses are unrestricted and the restrictions are at the revenue level. That's still the same, but the columns are a little bit different. I can quickly see how much is my endowment. I can quickly see how much is program. If I had time restricted, I may want to have that third column and show the total. These statements can be shown landscape. So the picture is the goal. What am I saying about my financial health and where the dollars are coming from? So you can see in this case, there was an increase to the endowment of $5,000, and then there were restrictions from the program restricted column to get this presentation. The focus here is on the donor restriction, not on the without donor restriction, meaning the unrestricted. Again, similar layout. We can see the organization overall is using some of the restricted funds that have been raised in the past to fund current period operations. Not different from today's statement of activities. In the next slide, we present to you a different example. And in this example, we're focusing on the without donor restrictions. And this example might be chosen by an organization that wants to emphasize the fact that without donor restrictions has a story to it. This organization has investments in fixed assets, which are not liquid. And in this example, they may be running a capital campaign. There may be certain expenses incurred that are related to the fixed asset. So there's some expenses in there, but for the general idea is we want you to see that there's a column for fixed assets. So of the total 1.5 million net assets at the end of the year, 1.2 is tied up in fixed assets. That's not a lot of liquidity for this organization. In addition to that, the board has designated a certain portion of its funds for board designated goals for the future. So internally, there have been either contributions from the sort of the external world that have been reclassified into the board designated. The 25,000 reminds me of organizations that have the policy that a bequest, if an organization makes a bequest, it will automatically go to the board designated reserves because the organization doesn't want to build an operating structure around a one-time gift. So we're showing the growth in the board reserve up to 150 at the end of the year. That's a story, a very important story about what portion of the unrestricted net assets and the activities are in the board designated category. And then we have this concept of undesignated. So that is the unrestricted. And for those of you who follow our thinking, this is the Luna column. This is the column where the liquidity is flowing for the year. So from a liquidity perspective, this year, we actually used up $4,900 in the liquid part of our operations. So this shows an organization with 1.5 million in unrestricted net assets and only 70,000 in liquid net assets. That organization may want to think about when it does its liquidity analysis, does it have the resources available to cover future commitments? So where is our story? What do we need funders and other stakeholders to see? That will depend on which presentation we choose to do. Today, this would not be an option in the way that the financials look. It could be an option for you in the future. So remember, disclosure is about what's the story that I want to tell, and liquidity being a really critical part of the overall message of these updates and the financials as a whole. I think, as we mentioned before, we had to say, well, what's the one major difference between the old and the new? It's about clarity of restrictions and clarity of liquidity. That being something that organizations need to be very clear about for their long-term sustainability in terms of their financial health. So those are two examples. We'll continue to follow what other examples are out there by early adopters. And at the end of the webinar, we'll talk about the next time together, where we will have compiled yet more examples as we see them. So that ends the update on the classification part. And I will now turn it over to Gina to take us to another exciting part of the update.
So on the next slide is our last recap portion, where, if we recall, last time we were together, we talked about the fact that in today's, or in the old old FASB rules, only voluntary health and welfare organizations, only certain kinds of nonprofits had to report expenses on the functional basis. So not everyone had either a statement of functional expense or functional expense disclosed in their footnotes. And so, to remind everyone, functional expense is when we're, again, disclosing our spending in the three categories, which would be program expenses, management and general expenses, and fundraising expenses. And so here we remind ourselves that in the new rules, all nonprofits are going to be required to, again, disclose their expenses by functional category. And so that disclosure could take one of three forms. We could disclose our expenses in those categories either on the face of our statement of activities, right there, right in the financial statement, in a separate schedule, or in the footnotes. So again, this concept of new items being required by the FASB, is sort of also being also giving us some flexibility in the way we disclose. So they're not requiring a statement, they're giving us options for how we present that info, but for sure, it's with this concept of giving more information and clarity to the readers of our financials. We also have to disclose in words and explain to the readers of our financials what we have chosen for allocation methodology. So what method do we use in order to decide where to categorize expenses in those functional categories? So how do we know how to split up costs between program, management in general, and fundraising? And so if we move to the next slide, we'll just sort of look at a little bit more of an idea as to where FASB was coming from in requiring this information for everyone. It's with this background of FASB thinking about that this information would be helpful and useful in folks figuring out how to associate spending at the nonprofit level with service efforts and accomplishments of the nonprofits. They specifically state in the ASU that this information is to help donors, creditors, and others in assessing the cost of services and how nonprofits use their resources. So again, we're getting this flavor that, there's some talk of liquidity and availability of cash flow for the next year. Now some look into our recent spending for the last year, kind of looking to tie into where dollars are being spent, program versus otherwise, and how about tying that into program service accomplishments and efforts of the nonprofits. So again, interesting, it's all around decision making and making judgments about the health of a nonprofit, now tying it into program accomplishments as well. So if we look to the next slide, we have just a standard presentation. The little tiny numbers here aren't so important, but more so this idea that we've got expenses here in the functional categories. So Hilda, if you want to sort of talk to us about, again, this presentation may not be new to some, but this, enhanced thinking about tying into program service accomplishments and learning about where our costs lie.
Thank you. Absolutely. So the statement of functional expenses, I always think of as the closest document in the audit that connects to an organization's budget. And so this is the spending pattern for the organization across 4 programs and what's called supporting services. There is a national conversation out there. Some call it true cost, full cost. The idea is funders want to understand what the total cost of service delivery is, and nonprofits want to be able to tell that story. And when we work with funders on this concept of overhead and what's the right percentage and what should I be funding, we bring them back to this statement. This statement, if prepared consistently with your budget, is a message around what is my program expenditure and what are my supporting services, also known as overhead. So when I said earlier that there are things about what's happening in 2018 that you may want to start to think about, I'd like you to think about the statement of functional expenses as this translation of your budget and as the message to the outside world of what your full cost of program services are. So each of these programs contain some direct expenses and some shared expenses through these allocations. Coming through from a budget perspective and then the audit, and using this as a tool to support your overhead rate with your funders as you write grant proposals and budgets for those grant documents, it would be really helpful to connect all of these as part of this message of what is my total cost. So if you're not confident that you believe those two connect, I encourage you to do that and think of this as your message around your budgeting. Gina?
Great, thank you. And so if we move to the next slide, we have 3 more topics that we've not talked about in our prior presentations to you all. And so these may not be applicable to all nonprofits, but we want to sort of, as we mentioned, there are other concepts that are getting a lot of lip service in the world for the new FASB requirements, but these are 3 others that are also encompassed in the same update. So the first of 3 that we want to chat about is this concept of some new options for reporting investment returns or net investment expenses. So for organizations that have investment portfolios, endowments, things of that nature, this will apply to you potentially. So the message here is that right now on our statement of activities, we present investment income net of expenses. That's not changing, but what is changing is potentially there may be some additional expenses that could be considered to be investment expenses. There's potential for some internal costs that involve the direct conduct or direct supervision surrounding strategic and tactical activities having to do with the investment portfolio. There's option for that to be potentially considered an investment expense. And so if that were the case, that expense would be able to be net with investment income. So again, this is really particular to folks that do a lot of internal management of their portfolios, things of that nature. We're not talking about external investment managers and things of that nature. Those always were net with investment expenses. So again, if this sounds like potentially it's something that could have applicability for your nonprofit, you really would be best to talk to an expert and sort of look at this a little closer to try and help you make that decision. So that's what this sort of new update that kind of snuck into our FASB ASU is all about. That's the discussion on that. If we move to the next slide, Our next topic also has to do with investments, particularly endowments. If we move to the next slide, this concept of underwater endowments. So again, won't apply to all nonprofits, but if you have some assets that are invested and for which there's a requirement to maintain some certain value, it could be that an external donor has indicated that the asset balance has to be at a certain level. It could be a law that's governing that you've got to maintain a certain balance in an endowment fund. Well, what happens when the market sort of takes a downturn? And so you've got your same kinds of investments, but it's just they're worth less. Not worthless, they are worth less than they were yesterday. Tomorrow they could be worth more, right? So we know the market goes up and down. If we move to the next slide, we'll see that when this happens under old FASB rules, it's sort of considered a borrowing from the unrestricted. So what happens is under old FASB rules, our endowment restricted assets stay at the level required by law or by the donors, and we sort of put that borrowing, or that we put that loss in the unrestricted. So that's changing. Okay, so we've got some differences in how this loss position in our endowment funds is going to be categorized in terms of the restricted categories. We're also going to have some additional disclosure if this situation applies to us. So there's going to be additional information that we're going to have to tell the reader of the financials, about where specifically, which funds are in that underwater position, and a little bit of information giving the dollar magnitude of that. So again, if this applies to us, we're going to have some additional disclosures. If we move to the next slide, the last concept, which is a new concept that we've not yet discussed, that's encompassed in the FASBs, is having to do with expiration of capital requirements, which really means we have received either a gift of fixed assets, or we receive dollars externally restricted by a donor or a funder that we were to use to purchase a fixed asset. So under the previous FASB rules, we had two options for how we would treat the releases of those restricted dollars. So we know that when dollars come in externally restricted, they're going to be in the donor restricted column. We had two options, one called release over time, where we could release a little bit at a time from the restricted net asset category into the unrestricted over the life of the asset. That option's going away. Right now, everyone's going to have to use this second option, the placed in service approach, which means that when the asset is purchased with the restricted dollars, all the revenue becomes unrestricted or goes into the without donor restricted column. And if we have assets that were purchased years ago with restricted dollars and we use this release over time approach, and there's still some restricted money that's not yet been released, we've got to sort of catch it up. So we've got to act as if we always use the placed in service approach. So that could apply to folks that, again, could have run capital campaigns, things of that nature, and may have chosen the release over time option. Okay, so it's a little bit of technical information, and that rounds out, really now we've covered all of the topics encompassed in the new FASB ASU. So if we move to the next slide, we just want to remind folks again, these changes are taking effect for individuals who have a calendar year. So if your year end is December 31st, we're living in the year where these new pronouncements take effect. So when we report on our calendar 2018 activity, we'll have these changes in those financial statements. If we're a fiscal year organization, then we're going to finish out fiscal 18 with the old methodology permissible. And then when we start our new year and we do reporting for fiscal 19, we'll have to include these changes in our external reporting. And so as Hilda mentioned, in our either calendar 17 or fiscal 18 reporting, it's a great time for a dress rehearsal and to think about how the financials might look different and what our disclosures might say if we had to make those disclosures today. We have a little bit of time to think about it. We've got one more year, really. We move to the next slide. And so we keep saying we've got time, but we know, in terms of what are we going to do in this next year that we have to prepare, it's a dress rehearsal. We want to talk about what the financial statements might look like, if there's going to be something in there that either might be new and different, a surprise for folks. Talk to the board if there are policies that have to be shaped, if we've got to think about reserve policies, things of that nature that affect liquidity. Now is the time so that we could be poised to make those disclosures when the time comes, if we have to seek advice. And that advice, could be from our auditors, could be from legal, what have you, depending on what needs to happen for our organization. As Ruth mentioned, we're going to really talk about implementation a lot more in our May 22nd next webinar as part of the series. If we go to the next slide.
We're ready for questions.
We're ready.
Great. It's interesting, as I was watching the questions, some of them are highly technical and some of them are very relational. And so I want to start with the relational ones first, because I think they indicate a concern about how these disclosures are going to be received and what that's likely to do to the quality of the disclosures and the way the disclosures are made by the organization. So I think there are a couple of people obviously on the line who sat through our last webinar or our next to last webinar, which was given by a group of financial experts, including Sea Change Associates and GuideStar. And basically, the report said that there were around 50% of nonprofits in the organization that didn't have an appropriate number of months of reserves. In that context, and we certainly know that that it can be hairy sometimes managing a small nonprofit, especially one that's subject to the whims of a state government who doesn't pay its contracts promptly and is working for contracts under full cost, that kind of thing. So given that we understand that there are a lot of organizations who are struggling with liquidity, what do you think are the things that people need to think about as they're doing this? I mean, people, I feel, are going to be somewhat cautious about providing a clear view of things if they feel like it will put them in a worse position vis-a-vis funders. And this is not a trick box that we haven't been in before. I mean, we've been in this box before where we felt like we had to report out overhead expenses or fundraising expenses in a particular way in order to pass muster. How do you think those dynamics might affect this disclosure requirement and the way people read these documents?
I'm going to take a shot and then Gina, please add. I think in the past, we've talked about Luna for years, liquid unrestricted net assets as an indicator of know your liquidity, but it wasn't, it didn't have to be presented. It was an option. I think FASB is trying to create that transparency. So the audit process will address this in a different way than perhaps it had before. So the numbers will pretty much speak for themselves, and anything that is disclosed on the financials, whether it's the presentation or the footnotes, the auditors are going to spend a little more time looking at and verifying. And so the number will be what it is, and organizations need to understand it. And this is why the dress rehearsal is so important, because if they're ready, the question is, how are we going to manage it? And in the disclosures, the organizations can talk about what their liquidity plans are. If there is a reserve, they can talk about that. Maybe the board has restricted it but intends to unrestrict or undesignate, I should say. Maybe this is a temporary situation where the government is delayed, but they believe that things will turn around because there's something specific. They really need to proactively tell the story about how they think it's going to improve. There are moments in time when organizations are challenged by the liquidity. If it is a permanent condition, then I think that will need to be discussed. What is the organization's plan to remain sustainable over the long term? Are they accessing credit lines? Do they have credit lines at their disposal if they need them? How are they going to manage? And furloughs would not be a good option, or delayed payment to vendors would not be a good option. So it's a story, and I think for not every organization needs to worry about it, but those who do want plenty of time to articulate that. Gina, would you add anything else?
No, I think that that's really the message, is that, as Ruth mentioned, we've been here before, just in different regard. It even happens today where I know sometimes organizations are nervous to receive a management letter comment, or I have an internal control finding. What are folks going to think about that? And the answer always is, well, what are you doing about it now? What improvements have you made? What's going on? There's a story. And so really it can be empowering to be able to think about, well, what is my story? I do have a plan, and so we just have to be able to articulate it.
Okay. Another related question, which I knew was on people's minds, and then I got it asked 2 times, was how will this affect the auditors kind of the possibility of an auditor's going concern decision? These are the hard questions, Hilda.
Gina, do you want to jump in?
And maybe you can explain what that is, just so that everybody knows. I imagine everybody does know if they're on this webinar, but.
Yeah, and so the reason why I was sort of thinking for a minute is I believe there's also, well, I'll do the background as you suggested. So the background is this concept of going concern is that when the auditor's out performing the audit, they're not just looking at, what happened as of your balance sheet date. So for instance, if I'm a December 31st organization and my audit is happening right now, my auditor is going to have a 1-year look into the future and sort of has a responsibility to tell the readers of the financial statement if this organization doesn't look like it's going to make it in the future, right? If it looks like it's a concern to have sustainable operations. And so, really, it could have some bearing. I think that auditors have this view anyway, that auditors have their eye on going concern anyway, and they likely would have jumped to a conclusion. I don't think that, and I could be making a wrong assumption, but I don't think that this in and of itself would give an auditor concern, because I think they already look at that, and it's not a new concept for an auditor, the concept of having to look at going concern. It's always heightened in an audit anyway.
And that normally, when there is that concern, it starts to show up in the footnotes, typically the very last footnote. And so it may be, if there was that concern, that the story about the liquidity is the same story. They usually call it ongoing operations, as to not be too startling in the title. But in that footnote, we'd be hearing about what the plans are to remain a going concern because we will be able to manage the liquidity. So
Right.
That'll be an important footnote.
Right. And I think these are things, I think one of the things that we found during the whole fiasco of trying to look a particular way in terms of our overhead and other ratios is that people would essentially fudge the numbers. And so that doesn't provide very good protection for people who don't fudge the numbers. But it is a little bit of a situation that's going to have to be worked out. And I think it really argues in favor of spending some time well before you have to do the actual reporting to really consider how are you going to tell the story that you have to tell. So I think that's a really important point that you've been making. Finally, I think that there are a number of questions about general expenditures and management, and what that does should include, how it relates to the statement of functional expenses. And could you just go over that one more time for us so that people feel like they're really fairly clear about what you do and don't know about it?
So I'm going to answer the question on management in general, and then I'm going to let Gina talk about this general expenditure for liquidity purposes, because they're two different questions. So the first one, in our May webinar, we will give some implementation guidelines that we've been working on clarifying what constitutes program, what constitutes management in general, and what constitutes fundraising. There's not a lot written about how to think about it, and so we are working on that actively as we speak to give examples of what kind of costs get categorized in the different areas that really reflect how people are investing their resources. So, for example, marketing will often cut across all three, and it's not an overall management expense. We'll give you more guidance on how to really think through what constitutes overhead in the clearest way so that you really can tell, where am I investing my dollars? The second question, Gina, do you want to describe that and what it is and isn't?
Sure. And so this concept of general expenditures that comes into play when we look at what we have available to fund our general expenditures for the next year in our liquidity disclosure. As I mentioned, on purpose, the FASB did not define general expenditures. So really what they were getting at is if we look at our normal operating budget, what I'm hearing, what are the year-to-year costs to run our organization, sort of potentially excluding, one-time costs, special projects, things of that nature is what we've been hearing. But it's by design, they did not define that, just because I think it's so different from one nonprofit to another as what might be a general operating expenditure. As with all things accounting related, consistency is really important. So when we look at this, once we define for our organization what is included in general operating expenditures for us, we want to think about that. We want to document how we define that, and then we want to consistently apply that year after year so that when we look at our trends of our liquidity, things of that nature, it makes sense because we're not sort of changing up our definitions every year. So it's for us to look at, make a decision, and then be consistent.
Absolutely.
Okay, so as we end this session, we have a lot of questions which I want to bring into the following session. But I think the thing that I see most called for are examples from organizations that have already done a trial run, if that's at all possible, so that people can see the kinds of decisions that they had to make. and the story that they were trying to tell, and whether, you know, and be able to look and see how that story was told in a little bit more detail than what was here today. So that's just a marker for the next time. And are there any final words that you'd like to impart, Hilda and Gina?
I would say think about it. Take the last set of financial statements as of the last fiscal year and put them through this new lens and see what it looks like. I think the webinar on May 22nd will help with that. We have an implementation checklist for you to help you decide what applies to you.
Great. Thank you very much, and we'll see you back here on May 22nd. And we're going to leave the questions panel up for a couple of minutes so that you can ask the rest of your questions, and we'll capture them for the next time out. Sorry. In the meantime, you can visit our website for the first 2 sessions related to this series, and don't forget to mark your calendars for May 22nd. Thank you.
Thank you, everyone. Have a great day.